Hello. Today we look at when it's a good idea to decide to sell your investment. Here you can think about to sell and get money from your investment, but you can also think about looking for a different direction, so replacing it. Selling the investment is rarely discussed, although if you want to invest, you have a numberless choice and one more. Each of these performs according to the cyclicality of its own market. Each has a projected time horizon, at the end of which you should look for another direction for your capital. Outside of the time frame, you obviously have a purpose for which you started, so if this is not being met, or you are making more money elsewhere, it is time to switch. In this video, I use securities and mutual funds based on equities as an example, but you can use the principles for your investments in other asset classes too. First of all, let's look at the two main events that should in no way justify selling your investment. The first is when you see a financial setback, commonly known as a crisis, manifest itself in stock prices. If you didn't take action before the crisis, selling after the crash typically doesn't save you from further loss, but realizes your loss. This will make it even harder for you to get at least your own money back later. In a situation like this, if we are talking about average investments and not the money you need to make a living, the best thing you can do is to wait until the storm clouds pass. It may take a few years, but in the meantime, the exchange rates will settle down. The other reason why it is not advisable to think about selling is if the investments simply haven't had enough time to show any results. If you have selected a stock or an equity-weighted fund after due review, its recommended time horizon is over 5 years. This is not by accident. Think of this investment as a seed of money. It needs time to grow. If it's only been 5 weeks instead of 5 years and you see that it's not soaring, but going down, that could be perfectly normal. You have to be patient. After all, this is not a bank deposit where returns are guaranteed for a short period of time. However, at the end of the recommended period, the seed of money will grow and can give you a nice return. Now that we've reviewed this, let's look at some of the cases where it's a good idea to at least think about selling. The first reason is if your investment is underperforming relative to the benchmark. The benchmark is nothing more than a sample portfolio that is very close to the investment basket you have put together. That is why it can serve as a benchmark. It allows you to compare apples with apples and pears with pears. The benchmark for investment funds is other funds investing in a similar area. For example, those investing in shares of Chinese companies or those focusing on the technology sector. This tells you how your chosen investment is performing relative to current market conditions. In a good case, you make the comparison before you allocate money anywhere. But no one can be 100% sure of their choice, so even with the greatest care, you may find out afterwards that you have miscalculated. If the fund you have chosen has underperformed the benchmark over the last 1 to 2 years, it is time to rethink this investment strategy. The fact that the benchmark has outperformed your preferred solution in the past is a warning sign, but it does not mean you should immediately sell what you have accumulated. After all, the market has cycles. In a downward trend, it may not be a good idea to sell everything. This is what has already been said about the downtrend, that waiting can be useful for you. If your mutual fund has produced an average annual return of 12% over the past 1 or 2 years, and the grand average is 15%, that's a good argument for selling the investment. A 1 to 2% difference may not sound like much, but the effect of compound interest means that the difference is significant in the end. If your investment has a persistent negative return, even though the benchmark is positive, I would definitely reconsider selling it before it generates further losses. Watching the benchmark is also important if it performs poorly in a down market. A bear market is no different than when the stock price is falling. When it appears from either the news or the numbers that a financial setback may be in the cards, you can prepare in advance by looking at your investment's past performance. It may sound strange to expect good performance when all stock prices are falling. But in a bear market, it doesn't matter how much the exchange rate has fallen. In the case of a company, it can be problematic if it has a high level of debt relative to its revenues. An aggressive financing strategy may allow for faster growth, but it can backfire hard in a crisis. Interest on debt has to be paid even when orders are down, and investors know this. And not everyone wants to take the increased risk, which could lead to a deeper fall in the exchange rate. The second, which may be a reason to sell if you have not chosen according to your own risk level. Everyone makes mistakes, so as an investor, you can make the mistake of not choosing an otherwise well-performing investment fund or a prosperous company according to your own risk level. Then the argument for selling the investment is that you can get more returns elsewhere if you underchoose them. And if you take too much risk, you'll sleep better later. If your investment is doing well, but the risk is too high for you, you can leave there a small part of your money. The part where it doesn't matter where it is at any given moment, a kind of playing money. Then you have the opportunity to learn and experience, without being taken away by the ambulance every time you hear the news. It is advisable to consider selling if something has changed a lot. For example, the investment policy, or the manager of the asset fund, or in the case of individual securities, a very different management team compared to the one that has been in place. It is not common, but not impossible. If the new investment direction is not right for you, this is a good reason to sell. After all, you no longer have the asset in your basket you said yes to. Change always involves risk, and if you don't want to take that risk, then you obviously have to make the move. This change may also mean that an investment that has performed well against the benchmark may now lag behind. Obviously, this can be seen as a positive. Your decision here will be driven mostly by trust. Rebalance your investment if you are close to reaching your financial target. Don't leave it to the last minute. The price of any investment will move. Sometimes quite a lot. But that's probably why you invested, so that you can buy cheap and sell expensive and make a profit. Price movements over a short period of time are true not only upwards but also downwards. That is why the recommended time frame is always indicated. The longer this time frame, the riskier the instrument. You should rather withdraw your money half a year earlier than necessary, rather than be stuck in a market downturn and possibly miss your target. Financial planning is very important. The closer you are to your goals, the less risky the asset you choose. Obviously, you don't have to do this with all your capital at once, just rebalance an increasing amount into a lower risk asset. You can achieve this through diversification, which you need here because of the passage of time. Of course, there is an argument for selling if you are actively managing your money yourself with the help of an expert or on your own. Part of active management is that you trade regularly. So after reaching a certain level, you will sell the stock purely to realize a profit. Then your money will move on in a direction with a higher return potential. Later on, of course, you can buy the same thing without any further ado, possibly at a lower price. If you have the expertise behind you, you can swap your existing lower risk assets for higher yielding but somewhat riskier ones.